good evening, everybody. Let's start this event. Very quickly, let me share my screen. I will give the floor to Nadia Filali, who is the Director of Blockchain Programs at Casa de Depot, as well as the Treasurer and Member of the Board of Directors of INATPA. Nadia, the floor is yours.
Thank you, and thank you, Xenophon, and hello everyone. Thank you to be present for this event, even in the night, from INATBA. INATBA, it's the leading convener in the global blockchain ecosystem, offering developers, company, and users of blockchain or distributed ledger technology a forum to interact with regulator and policymaker and bring blockchain technology to its next stage. Today, INATBA is over 160 companies as members from 40 countries, over 20 governments sitting on the government advisory body, and also 40 academics sitting on the academic advisory body. This large membership is based on the basis organized into 14 working group, of which the finance working group, who is hosting this event tonight, is the largest. And the finance working group is active in addressing very large topics such as CBDC, but also decentralized finance. And most recently, the European Commission proposed a regulation on market in crypto assets named MiCA. And this proposed regulation is going to, we hope, definitively change the landscape for crypto services provider and crypto assets in Europe and beyond. And so INATBA is naturally responding to both the finance working group digital finance package task force, and has established a MiCA task force led by our academic advisory body, which is gathering evidence for the wider ecosystem to ensure wide and inclusive engagement. And hope we are working well together on this point. If you don't join us, I think perhaps back to today event on CBDC's currencies, convened by the INATBA Finance Working Group. And on behalf of the INATBA Board of Directors, we thank you all for attending, and we hope you will enjoy what will be a very insightful and thought-provoking series of discussion. The menu is very rich tonight, so I hand back to Xenophon to introduce the first panel, and thank you for your participation again.
Thank you, Nadia, and thank you everybody for joining us. Without further ado, I am passing the floor to Mr. John Velisarios, who is Global Managing Director for Blockchain and Multi-Party Systems at Accenture, as well as the lead for digital assets, custody, and CBDC. John, the floor is yours.
Thank you, Xenophon. It's great to be here. Thank you, everyone, for the time you've taken today to attend this session. This is a very exciting topic. We've been working in this area for a number of years, and I just wanted to say that this is an area where we have spent quite a lot of time working on various engagements, and we're happy to be involved in such an exciting sort of panel, but also in terms of interacting with such great thought leaders in this area as well. So for the panel, I just want to quickly introduce the panelists. I'll talk a little bit about sort of the agenda as well, and what we want to cover in this panel, some housekeeping, and then we'll get straight to some of the questions and the discussions. So the first thing I wanted to do is maybe just mention obviously our panelists that are in the session. John Kiff, who's a senior financial sector expert, Global Financial Stability Division in the Monetary and Capital Markets Department at the IMF. Ahmed Faragala, senior financial sector specialist at the World Bank. Andrea Pina, who's a lead expert in innovation, part of the innovation team at the European Central Bank, the ECB. And Henry Holden, who's an advisor at the BIS Innovation Hub. So I'm delighted to be on moderating a panel with such great experts in this field, and really looking forward to the session up ahead. First of all, secondly, I just wanted to mention, I guess, the agenda. We'll talk a little bit about some definitions. We'll open up into introductory questions and then get into use cases and so on. But the first thing I wanted to cover, I think, maybe is to just go around and ask each of the different panelists, spend just a couple of minutes, quick introduction about the work that you and your organizations are doing in this area. And then talk a little bit about whether you see sort of CBDCs and CBDC activities in your space, and some initial thoughts. So just go around, maybe start with John, and then go to Ahmed, and then Andrea, and then Henry as well. So maybe John, if you can comment on that, that would be great.
Thanks, John. Yeah, I'm the IMF, and I'm involved very deeply in our fintech work more generally, but most recently very focused on central bank digital currency. So one of the things we're actually doing right now is building out what we call a technical assistance program, by which we'll be advising member countries who've come to us asking us, first of all, should we or should we not issue central bank digital currency, and then dive into the details of design features and whether or not they should be looking at it, and so on. So it's we've actually started that program up, and I fear the floodgates are going to open, since we've identified something like, there's about 50 countries out there, I think, that are contemplating issuing CBDC. So that's where we stand right now.
Very good, thank you. Ahmed?
Thank you, John. I work for the World Bank in the Payment System Development Group, and we actually, CBDC is part of, I have to say, the portfolio that we are managing right now. We provide technical support to countries as well when it comes to the approach of having CBDC. We are as well developing a couple of reports related to CBDC. I think they will be issued within this year. Actually, CBDC is part of the payment systems in general. So as well, we are allocating the CBDC as part of the national payments system in the country, and how it can fit with the other system. Thank you.
Okay, great. Andrea?
Thank you, John. Yes, thank you for the introduction. You have already said pretty much everything. What I can add is that I'm responsible for the team working on the design of a possible digital euro within the ECB, and I've been coordinating the drafting team that prepared the report on a digital euro that the euro system issued at the beginning of October. So yeah, this is pretty much my connection to this space.
Great report. Thank you. Henry?
Thank you. Yeah, Henry Holden. I work for the BIS, which is another sort of strange organization launched by treaty, but that I'm in good company with the IMF and the World Bank. So I work in the Innovation Hub in the BIS. We work for our shareholders, which are all central banks, more than 60 around the world. And so we work on the more sort of practical aspects of CBDC. Not so much on the policy side, although my boss, Benoit Courir, is co-chair of a group with John Cunliffe of the Bank of England, who published a report last month on the sort of more sort of policy side. But in the Innovation Hub, we're supposed to be sort of doing more experimentation and kind of more practical policy sort of work.
Great, thank you. So what I'd like to do is maybe just spend a couple of minutes, if you allow me to, maybe share some thoughts on the topic of CBDCs for the attendees. This is an area where we're seeing a tremendous amount of of sort of interest of late. I think in the last several months, there's been a sort of a floodgate of activity in this area. Very excited by that. It's really good. I think because we've all been focusing on this for a bit of time. But at the same time, what exactly is it? What is a CBDC? And basically, and sort of there is confusion in the market, I think, in general when we talk about this topic. Hopefully, by the end of the session, we'll have better clarity. I'm not going to attempt to sort of academically go through all the various options and different aspects of it, but at the same time, I do want to spend a couple of minutes just to describe it a little bit. When we have a very a point of view on central bank digital currency as well, and given that we've been spending some time on this topic over the years. So I'll share our point of view. I mean, I say we, I mean Accenture and the organization that I lead up. But at the same time, there are, of course, various views, and part of this panel is to debate some of this as well. So I'm looking forward to some challenges in this area. So from our point of view, when we talk about central bank digital currency, we've looked at this again for some time, and I think that there is account token-based models. There are hybrid approaches. There's a variety of different options that you can implement with regards to a CBDC. And we have a very sort of pure view of it. And when we talk about it, we mention, we refer to it as sort of a digital bearer instrument of central bank money. So if you take banknotes in tokenized form and you issue those, that's what we refer to it as. And if you have some ideas about this in terms referring to my panelists, please comment on this as well. But at the same time, there are some very specific definitions that we apply to a CBDC. Now, more broadly, obviously there's a lot of papers that have been written about it, and then there are many different options around in terms of implementing central bank digital currency. There's account-based models, there's token-based models, or value-based models as well. And I think that's something that we've also seen, and I think hybrid approaches and I guess the options are all out there, and there's a variety of different types of technologies that can allow you to implement those. And at the same time, it's not very clear how the role of various intermediaries in the marketplace, the financial institutions, what role they would have going forward with such a central bank digital currency that's been issued. So there are some specific topics that I think come to the core of the discussion. I don't want to debate them all here, but we will cover them hopefully throughout the session. Now, I did mention a little bit also about whether you have different options, and we spent some time also looking at retail, wholesale, and also cross-border applications of central bank digital currency. We spent some time obviously on project work that we're doing in some Nordic countries, and of course that's more in the retail space. But there's also a lot of activity happening in the wholesale space, and I think in the wholesale markets there is definitely interest for security settlement, for instance, for commercial banking operations, and so on. And I think that's an area where there is a lot of interest given the digital asset side of the story as well. And also an area where we see a lot of potential is in the cross-border space. Given there's a lot of friction in cross-border payments, what is the role of a central bank digital currency in such an environment? And I think there we have a lot of potentially innovative applications of CBDC. And my view is that I think it's probably an area where it'll probably get the most interest because of the challenges that are faced in the cross-border space. But that's sort of to be defined, I guess, and as things develop. What I think what I'd like to do next is maybe just go around for all the panelists and talk a little bit about a couple of different questions that I have. One is, what kind of CBDC activities are you exploring? I mean, you mentioned it a little bit in your introduction, but specifically, is it, given what I just described, is it in the retail space, is it in the wholesale space, is it cross-border, or a combination of all of those? I think that would be interesting for the attendees to hear about a little bit more in detail. And I guess also, what is your perspective on synthetic and hybrid CBDCs? Because that's an area where combining a number of these different topics can give you sort of optimal implementations, of course, given the hybrid approaches that could be taken as well. So I'm interested if we go around, I guess, around the panelists in the same, maybe in the same order. What are your thoughts on some of those topics? What work is that you're doing related to CBDCs and also that you're exploring, and also the kind of your perspectives on synthetic and hybrid CBDCs?
Okay, so I'll start off, John. First of all, I should make it clear that my focus is absolutely purely on retail CBDC for general purpose usage. To me, wholesale is kind of in another domain altogether. We have another group at the IMF that focuses on financial market infrastructures, and that's where they're looking. But I'd say the most active part of our technical assistance program, in fact, absolutely almost all of it, is on the retail side. And as some of you may know, my boss, Tobias Adrian, published a paper last year that advocated for the so-called synthetic central bank digital currency, which is essentially a stable coin that instead of being backed by commercial bank deposits or high quality securities, it's backed by central bank reserves. Basically, the stable coin issuer deposits the funds at the central bank, which makes those funds more secure. Now, this is where, we often, when I give a presentation, I'll say, these are my views only and not the views of the fund. And this is an example where we may diverge. I'm not a great fan of this so-called synthetic CBDC. I think it's a great idea that central banks open up their balance sheets for stablecoin issuers, because that will create a more secure stablecoin. But to call it a CBDC of any sort is kind of a stretch. So I'm kind of a purist when it comes to CBDC. It should be issued by, on the balance sheet of, and absolutely under the central bank umbrella. In terms of cross-border usage, I mean, what we advocate, and this is where we get kind of fuzzy territory, we advocate future-proofing the design so that it can be interoperable with other CBDCs around the world. So that's a nice thing to say, but it's a challenging thing to actually implement. But even though we're very focused on domestic use cases only, we really think it's important to design with that future usage in place. And so we're also part of an effort at the International Telecommunications Union that's kind of looking at the different dimensions of CBDC and where interoperability and standardization might be possible. So that's where we're focusing right now.
Thank you. Ahmed?
Thanks, John. I think I agree with John Kev on the aspects related to synthetic CBDC. But maybe let's have a look at the beginning on the major concepts, or I can say the properties of a CBDC. Mm-hmm. First, it should be a central bank liability. It should be denominated in the existing unit of account. By the way, it could be the unit of account in the future. If at a point of time there was no cash, then the value itself will be only reflected with the CBDC. So that's a unit of account, a medium of exchange, and a store of value. And those are the high definition of any sort of money, but with the CBDC, it should have a digital form. So so when it comes to synthetic CBDC, I agree with John Kev and with the paper that have been published recently by the BIS and a number of central banks, where they were having a big box saying that synthetic CBDC is not CBDC, and actually it's clear because it's not a liability on the central bank, but it's rather a liability on the issuer, which is in this case maybe e-money issuers or others. So it's a sort of a narrow banking rather than a sort of a CBDC, and this created some confusion in the past. But I think things are going clear with time. The other point that you mentioned related to hybrid model, and I think this is a very interesting model, and it was further analysis within our view in the bank. We see that basically, the hybrid model is the model where, despite the central bank is the issuer, but the central bank is applying a two-tier model where one tier is used for the distribution of CBDC between the central bank and other commercial banks or payment service providers, or whoever, whatever type of service providers, and then the other tier is used for the distribution of CBDC between the service providers and the citizens and businesses. So actually this looks a very interesting model when it comes to, I mean, the hybrid model. The point here is that we see that we may have a sort of a number of identified levels of intermediation or decentralization between the central bank and the service providers. So one of them could be who is managing the accounts. That's one level, and that was clear in the model developed by the BIS. But other aspects as well was more focused, including, for example, who is providing the user interface and to which ledger this interface is accessing. Who, for example, what is the level of access to the ledger between the central bank and the payment service providers? Do they have full visibility to the whole access? Do they have visibility only to partial parts of the ledger? Yes or no? And at the fourth point was the contractual relationship between the central bank and the payment service providers. And here is, this is from legal perspective, it could have impact, because if we are considering the central bank outsourcing the part of the operation to, for example, service providers, that would have implication that's completely different than having the service providers as the main responsible entity of the service that is provided. So we can see that the hybrid model, and actually we see that it's all about the level of decentralization between the central bank and the service providers, and we can see a lot of model there, and we can see a lot of development in this area. Thank you.
Thank you. Very good. Thank you. Andrea?
Yes, well, what can I add? I'm personally working on retail, as you called it, retail CBDC. So what we call digital euro is basically retail CBDC denominated in euro. Wholesale applications, well, in the Eurosystem analysis, we think that that's more a matter of modernization of the current market infrastructure, the current RTGS system. So it's not really a new type of money, new form of money. It's very interesting, very important, perhaps to indeed provide interoperability on a 24/7 basis with security settlement systems based on technologies other than the traditional centralized technology of an RTGS, but it's not per se something that would change the economy more broadly and the functions of money in the economy. A retail CBDC, so what we see as a digital euro, instead would be really something new. Is kind of a mix between the central bank money types that are already available. Banknotes are only available in a paper form, of course, but to the general public. Reserve accounts are digital, but only available to a restricted set of counterparties. And then, of course, a digital euro by making a central bank liability available to the general public in an electronic form, that would be really the innovation. Now, I said central bank liability, and indeed, in this respect, I fully agree with the panelists that spoke before. A CBDC, by definition, is a central bank liability, which leads me to say that a synthetic CBDC is not actually a CBDC. In Europe, we have a very clear regulation on what we call electronic money. That's something issued by a private entity, a claim on a private entity who backs those funds in another form of money, can be commercial bank money usually. In some cases can already be central bank money in the form of reserves, but still that's not a CBDC, that's something different. It's a claim on a private entity, and therefore it entails the credit risk of any private claim. There can be technical issues that allow the amount of so-called synthetic CBDC in circulation to be different from what is stored in the central bank's account. And there, the issue is one of whether the central bank would step in to say, okay, you users, you expect to be holding that money, so I will give that to you. Well, in that case, then we would be talking about a central bank liability, because the central bank steps in order to satisfy those expectations. But otherwise, it's really a private form of money, what we call, indeed, electronic money, very clearly under EMD2 here in Europe. So yeah, I think this is the main point on hybrid. On hybrid CBDC, I wonder whether the term hybrid really fits, because hybrid seems something in between two different forms. Again, if it is a liability of the central bank, so a safe asset, then it is a CBDC. The fact that intermediaries are used to the extent that it remains a liability of the central bank makes it a central bank digital currency in all respects. Then it's just a matter of the distribution model that can go through intermediaries or not.
Very good. Thank you, Andrea. Thank you. Henry?
So at the hub we're working on, I'm afraid we're working on all three, but I won't go into it. So on the wholesale side, we're working with the SNB, the Swiss National Bank, and SDX, the Swiss Digital Exchange, which is sort of being almost launched. But we're looking at sort of tokenized central bank money and tokenized security settlement, and it's honestly a lot more interesting than I thought it was going to be. You know, make of that what you will. On the retail side, the sort of the experiments that we're running are more kind of bite-sized. We're not planning to build an entire payment system. Instead, we're sort of looking at the wider ecosystem, and we're looking at experiments for certain aspects. So so we're looking at particular aspects of cryptography, or we're looking at APIs between the central bank and the possible participants or distributors of a CBDC. And I think that's the weird thing about all these conversations about CBDC is we're talking about something that doesn't actually exist yet. And I found your definition kind of interesting, John, because it's a bearer instrument. So does that mean the thing that the Bahamas just issued is not a CBDC? Because that's just an account, right? And, it's very easy to define something when it doesn't exist. It's really, really easy. It's more difficult to talk about it, and it's more difficult to analyze it. When it comes to, synthetic, I'm going to kick it when it's down as well. It's not a CBDC, but similarly to others as well, the point of a CBDC is not to try and crowd out other types of money. So just because you've got a stable coin that's not CBDC doesn't mean it doesn't play a really useful role, and people shouldn't be able to access it and use it. Any sort of retail CBDC should try and enable a diversity of different kinds of money. That's the sort of, that's a fantastic public policy objective of it. So it's not saying something bad. It's actually sort of, it's the opposite. It's a CBDC should be an enabler for kind of a more diverse ecosystem. And so seeing the different kinds of payment instruments and the different ideas flourish, that's ideally what a CBDC system should do. It shouldn't be some sort of all-conquering thing. And in a nutshell, that's what we said in the report last month, to which some people contributed. So, nod to Andrea.
Very good, thank you. And of course, definitions are will change over time, and people's views of things will modulate based on sort of learnings through the developments over the years, over the months and years, I think, as we sort of progress. So I don't want to sort of be absolute in sort of terminology at the end of the day, but at the same time, there's a certain view about what, so from a definitional point of view, what certain things that we're talking about, I think it's important to sort of define them as well. I think there's a couple of questions that I have, and I'll go through them. There's a couple of topics that I want to go around and ask each of you, I guess. The first one is focused towards John, and how will CBDCs be used within the general market? do you believe they will be used within crypto markets? No. It's an interesting question. What do you think, John?
Okay, I'm just going to share my screen in a minute here. Tell me when it's working.
Mhm.
Okay, and sorry, guys, I must be the Amazon guy here. Must be now, so that's why you're hearing the dog barking. So, anyways, let me just put this on slideshow. Yeah, so this is just speaking actually to the discussion about what is a CBDC. So you can see here that we agree, John, that should be a bearer type instrument, at least peer-to-peer. The bearer could have different meanings to different people, but it certainly should be peer-to-peer. But what I was going to do is I was going to move on to this next slide, which talks about the central banks that we have observed publicly talking about issuing CBDC or at least doing some research on that. It's kind of consistent with a survey that Henry was involved in, the BIS and the World Bank, I believe. They surveyed 60 of their member central banks and found that something like 80% were looking at CBDC. We went the other way. We're just basically looking for all the countries that are publicly saying that they're thinking about issuing CBDC. So we got 47 of them all together here at the various stages of development, including Ukraine and Uruguay, who both completed pilots. The Bahamas is also, they went through a pilot, and now they're fully launched. China's pilot in Eastern Caribbean Central Bank is going to be launching a pilot probably any day now. So very active area. Now, the next slide is the one that I want to focus on, because this, from our discussions with central banks and so on, these are some of the motivations for issuing CBDC. And what's interesting, I think, is that there's a fairly clear delineation between the emerging market and developing economies and advanced economy motivations, where emerging market or EMDE central banks tend to be focused on things like financial digitalization and reducing the physical cash costs and risks. So, for instance, with the financial digitalization, the Uruguayan central bank, one of the reasons they're kicking the tires of CBDC is that they've found that their financial sector ecosystem really isn't stepping up to the plate in terms of digital offerings. So they felt they needed to look at stepping in, or at least maybe kicking some butt a little bit to get some of those commercial banks and other players to step up to the plate. And then reducing physical cash costs and risk is a very primary motivation for banks like the Eastern Caribbean Central Bank and the Bahamas, where the cost of not just actually physically printing money and so on, but actually transporting it, in especially island countries, transporting means often transporting across bodies of water with all the risks of literally Pirates of the Caribbean robbing them of their cash. Some of them I think might be looking at reducing dollarization. I'm a bit skeptical about that one, because dollarization usually results from more fundamental issues that just changing the format of your money isn't really going to help very much. And then for advanced economies like Sweden and Canada, so on, they're in China too, to some extent, they're looking to introduce CBDC to enhance payment system competition, because the monopolies have formed in the private payment system and hardly anyone's using cash. And those central banks also want to make sure that the central bank money still plays a key role in the economy. And a more recent one, particularly in the US, was they were looking at CBDC as a potential way of distributing stimulus payments. And there's been some interesting literature on some wrinkles you can add to distribution of stimulus payments using smart contracting and so on, which is a unique feature of digital money that should be exploited if possible and safe. And they were looking at some were looking at the idea of introducing features that would increase the velocity of that money to make almost, there's a concept called Jessel money from 2 centuries ago, the idea that money that kind of burns a hole in your pocket, so you have to spend it, it depreciates over time. So that's kind of an interesting wrinkle. Another, of course, is reducing private currency adoption. And we say global stablecoin, and of course, when we say that, we mean the Libra. Of course, that's the kind of the elephant in the room. And another, and this is more popular amongst the academic community, proven monetary policy effectiveness with targeted policy. Uruguay, for instance, was one of their motivations was to access granular real-time payments data to help with their macroeconomic forecasts. And for some, the idea of having, if you make the CBDC interest-bearing, if you eliminate cash or make cash costly to hold, you can then use you can have an interest-bearing CBDC that would allow you to break through the lower zero bound on policy rates. But the big condition there is that you have to either eliminate cash or make it expensive to hold. Otherwise, as you break through the lower zero bound with a negative interest rate on the CBDC, people can just scurry back to physical cash. And that last question regarding what role CBDC can play in crypto assets, the way I interpret that is that I think there's a role for CBDC in stablecoins. And again, it kind of comes back to the so-called synthetic CBDC. And I think it's even mentioned in the Libra white paper, that the white paper 2.0, that the Libra stablecoin could potentially be backed by CBDC, as opposed to the alternative of actually putting the cash, putting the reserves into the central bank balance sheet. So that's my broad answer to that question. I'm going to unshare now.
Thank you, John. Thank you. Next question is for Henry, actually. Henry, how do you expect CBDCs to be initially deployed and tested? And do you see, will the private sector be invited to help or sign up for such tests and experiments?
In a word, slowly. I mean, so others could probably comment better than I can, because Andrea is living the experience. But I mean, one of the things we wanted to make clear in the report is sort of tying back the central bank mandate to CBDC, because a lot of the conversations can become a little divorced and a little excitable, and central banks are boring. Honestly, they have a mandate for stability, monetary and financial stability. And so therefore any CBDC issuance and any development and any testing will be cautious, because success means, not being sort of revolutionary, not going against the mandate and disrupting the system. The idea is to sort of not make a ripple in the pond. Fine. But then what does that mean for sort of testing with the private sector? Well, it almost means it's a necessity, because, sorry, I don't know if you can hear, that's my daughter and it's bedtime. And we're under quarantine, so it's a hell of a lot of fun. Sorry. So what does that mean for testing with the private sector? It means it's a necessity, because you can't just launch something without consultation. So any CBDC project development will have to follow a very long, laborious sort of collaboration exercise to get the private sector involved. And that doesn't just mean sort of the technology companies and the banks and things, the payment service providers that will be offering it. That means the merchants that will be accepting it, the public that will be using it. So some of the chat comments, we're talking about the ECCB experiments and the Bahamas and things like that. The public education exercises that those guys have gone through just for the pilot is astonishing. So for the real thing, it's a big deal to sort of say, this is digital cash on your phone to the general public. And so there's a huge sort of political question, both in the development and the design of a CBDC. So it is a massive, massive collaboration exercise, which takes a very long time, but necessarily so, because you want to get it right.
Good. Thank you, Henry. Andrea, how will commercial banks be affected by CBDC issuance? Will central bank market operations flow through the banks, or digital bank alternatives? What do you think?
Well, John, a nice thing about CBDC is that you can design it the way you want to achieve the objectives that you want to achieve. And Harry already explained very clearly that from a central bank perspective, stability is key. So the idea here is not one of maintaining the status quo per se. The idea here is that you need to make sure that whatever you're going to change in the market, in the economy, by issuing possibly this new form of central bank money, you're not going to create issues. So when you ask me what will be the impact on commercial banks, well, of course, CBDC as a digital safe asset, no, it's a liability of the central bank, so it's virtually it cannot default, no, is of course something that is very appealing for those who seek safety. So particularly in case of financial crisis, there may be a big push from potential users of a CBDC to shifting their deposits from commercial banks into CBDC, which may also allow financial crisis to erupt even in cases where they wouldn't have erupted beforehand. So yeah, this is a big issue that of course needs to be controlled. But there is also a more structural aspect to be taken into account, because depending again on the trade-off between the level of risk of CBDC and commercial bank deposits compared between them, and the interests that these two forms of money can pay, again, there may be a shift from commercial bank deposits into a CBDC. And that's something, again, that needs to be controlled somehow. A CBDC, in order to be useful, needs to be used by the citizens. So you need to be able to have some CBDC, but it shouldn't become, so to say, a new form of risk-free investment. It shouldn't be a form of investment. From the Eurosystem perspective, it should rather be a new, efficient, affordable, fully inclusive way of paying for retail payments. So in order to do that, there are some design decisions that can be taken. The two main ones that are usually discussed in the central banking community are those of limiting really the quantity of digital representations of central bank money, so of CBDC that the user can hold. But then there comes the issue of what do you do with additional incoming payments? That you could have a waterfall approach, for instance, that allows those incoming payments to be credited automatically in other forms of money. Another approach is that of using remuneration. So I think that Ahmed showed that the aspect of monetary policy transmission is not something that is driving most of the central bank research into CBDC. It's more about making payments more efficient, making the life of citizens easier, so to say. So still remuneration may be useful, although not perhaps for monetary policy transmission, in order to limit the appeal of a digital euro, again, as a form of investment. And we need to find the right balance if we were to issue a digital euro, in the case of the euro system, between indeed how much appealing the digital euro would be and how much you want to avoid that two big shifts happens toward the digital euro. And you asked me about the possible involvement of intermediaries, private intermediaries in such a system, in such an ecosystem, I would say. Well, their involvement is, of course, would be, of course, a way to ensure that they are still part of the game. And so there is still the relationship between them and the users of a central bank digital currency. So that's important for the reasons I said before. But there is also another efficiency reasons to be taken into account. A service given to retail customers is something that needs to be provided with much care, with much direct relationship. We are always unhappy when we find it hard to solve an issue with the provider of a certain service. So unless we really want the central bank to have branches in all villages in a country or in a currency area, so that we are ready to step in and help the users of a central bank digital currency, we need to rely on the services that and the processes that are already in place in intermediaries. So I'm thinking about the onboarding of customers, the checks of anti-money laundering aspects. There, the struggle is to make sure that this can happen while guaranteeing the appropriate level of privacy for the users. But that's again something that we need to tweak via the design features and also the technologies to be adopted.
Thank you very much. And you touched upon it, Andrea, and I'll ask Ahmed to comment on how will privacy and fungibility be protected in CBDCs? Will we see true cash-like properties?
Thanks, John, again for the question. Actually, it's a very strange time now. It looks like all the previous problem that the customers were or the community were facing with cash, with cards, with e-money. Yeah. Everyone looks like it's the time to resolve it with the CBDC right now. So many issues are evolving, and even a lot of solutions are proposed, which is great right now. So here we have a trade-off between the privacy and the integrity, and this is always a problem that the central banks were facing. So we have a lot of, I have to say, experiences or a lot of maybe experiments right now, how to resolve the issues related to privacy. One aspect, for example, is to, and by the way, the cash is attractive because it's anonymous. That's why maybe a lot of solutions thinking of the CBDC to be an anonymous product, or maybe at least to avail some level of anonymity below a certain threshold. So if, for example, you have a wallet with $1,000 or less, then you can be still anonymous. If you exceeded the threshold, then you need to identify yourself to the service provider. This is, for example, one solution that was proposed. Another solution, which is very interesting, is that to isolate or separate the personal information of the user from the transaction information. So if I'm dealing with the supermarket, for example, or the merchant, and I'm paying for the fruits and vegetables, I don't have to identify myself and to him, and I don't have to identify as well myself and my information to the bank of the merchant, and that's really a challenge right now. So one solution right now is to people thinking of to isolate the personal information from the transaction information, and based on this, only transaction information will be transferred, while personal information could be stored either centrally within the country, or maybe or even stored within each service provider, but not to be exposed while exchanging transactions. So we have a lot of approaches to resolve the issues of anonymity, and I have to say that again, people look, or many people look to the CBDC as a simulator to the cash, and they need to transfer the features of the cash to the CBDC domain, which is, by the way, it's not easy, but again, you need at least to ensure some aspects related to privacy without harming the integrity of the system as a whole. Thank you.
Thank you. Just a couple of questions, and then maybe we switch to a Q&A. But the next one I have, and this is for all the panelists. What are currently the greatest hurdles? And is there any scenario where CBDCs are not issued in the next 20 years? Henry talked about a long timeline. I think we appreciate the complexities of issuing such an instrument. But what are some of the issues, the biggest issues that we're sort of going to face, I think, in any implementation? And is there such a thing as, and what do we see in terms of being able to do this within the next 20 years? Anyone can take it.
Should I go first?
Please.
So I think, honestly, it's a compelling use case. So in the chat, somebody was sort of talking about kind of the programmable infrastructure and things like that.
Yeah.
And John sort of sent an interesting paper. There's lots of opportunities, including this sort of the programmability, so you can do some really funky monetary policy stuff that terrifies anybody who would have to implement it. But really, why? I think that honestly, if there was a real need for CBDC today, we would see it coming through. And you do in some parts of the world. Those projects that are really sort of motoring are ones where the central bank and the government and the people see, you know, this is something that we really want. And other central banks have sort of been very clear in saying, you know, here are the conditions, and this is why we're thinking about it, because in the future, the conditions might change, and we might need a CBDC. We might need a CBDC to continue our role as a central bank, to continue to provide stability and central bank money to the public, and et cetera, et cetera, et cetera. But actually today, there's not a massively compelling use case. There's a few people sort of very, very keen on it, and I'm very interested. Genuinely, I'm very interested to sort of hear about use cases that we don't really understand yet. But for both the wholesale side, you know, we haven't seen tokenized securities coming through, but we might. On the retail side, we haven't seen the disappearance of cash, but we might in some places faster than others. And we haven't seen, you know, cryptocurrencies exploding. You know, on the contrary, it's still really niche. So then, you know, why run at this? Central banks are right to be prepared, but there's no, you know, there's no fire.
Burning platform, right?
That's the phrase.
Comments from anyone or thoughts?
Well, I was going to jump in. I mean, I think my personal view is that I think there is a more compelling case for emerging market countries. I know around this table we're all from most of us from advanced economies, so and I agree that with Henry that I don't see a compelling use case in advanced economies where there's already many offerings of digital payment services. It could be that the central banks are concerned about these monopoly distortions that, you know, one or two, in the case of China, for instance, one or two payment providers dominate, but they dominate because they offer these really interesting ecosystems. So I think in advanced economies, central banks will run smack into that problem, that you don't just offer a CBDC in isolation. It's part of a whole package, and that's going to be hard to beat. When you're in some of these emerging market countries, it's a totally different scenario. You are actually offering something new, and you have an opportunity to build out something compelling for the retail user. So I think that's why you're seeing like Bahamas go quickly from pilot to reality. They're now fully in operation. ECCB is following up, and I think there's probably others percolating out there too. And they're just offering something that the private sector hasn't stepped up for. In terms of wholesale, I kind of I also agree with Henry. I think you got to build to make that really work, because you've got all these pilots. So I was reviewing these the other day. If we've had all these pilots, Project Jasper, they all date back about 2 years ago, and they all said, no, that works, okay, but it doesn't work any better than what they already have. So they've kind of put them on the back burner. I think what you need is to build out the tokenized security world that might activate things. So I was interested to see that the Commercial Bank of China issued a very large tokenized bond. The World Bank has done their Bond I. So I think that's maybe the more interesting direction. Once you have a lot of securities on blockchain, then you have a compelling case to build out a payment and settlement system that would be based on CBDC, because that would make that really come alive. And I think, Henry, your hub is working with the Swiss central bank, I believe, on such an opportunity. I think that's really where the action is going to be on the wholesale side.
Yeah, we're fighting with the report right now. So wait, December, it's unmissable.
Andrea, thoughts?
Yeah, if I may bring the discussion back towards the retail CBDC that we said is what we are actually mostly working on. I fully agree with the picture that has been shared by Henry and by John. Yeah, that's the picture. At the same time, Henry said before very clearly that it's complex. There are a lot of things that need to be considered. It's not something that you can do at the blink of an eye. It needs time. So it's important to look at trends. And if we look at trends, even in advanced economies, there are some trends that may need in the future in some cases may need, in some other cases may very much benefit from the issuance of a central bank digital currency. And that's, I think, the reason why many advanced central banks from also advanced economies are working on these. From the Eurosystem perspective, we have clearly said that by mid next year, the governing council, so the decision-making bodies of the Eurosystem, will decide whether to embark in a project to identify what a digital euro might look like. But we are also very clearly stating that this decision is completely separate from the decision to issue a digital euro, to issue a central bank digital currency. Because again, one point is that of being prepared so that when these trends that may sometime pick up very quickly lead us to scenarios that may need the issuance of a digital euro. And another thing is to say that a scenario materialized and the issuance of a central bank digital currency is necessary. So again, I think that looking at trends and looking at the time needed in order to define and design and build a solution that is a central bank digital currency, basically that's the reason why we are already working on that, even though the picture, as I said, is absolutely the one that Harry and John depicted.
Very good. I have a question. I mean, we have questions coming up on the chat channel, so I'm going to ask the one from Ashley here. Says that I am from St. Kitts and Nevis, which is covered by ECCB's digital currency, and I can see the demographics difference and apprehension which comes with CBDCs. Moving forward, how significant will demographics, specifically age, impact usage? It's a question, I guess, for all of us.
Can I jump in real quick? So from the euro area perspective, at least, we said very clearly that a CBDC, a digital euro, wouldn't be a replacement for cash, which is what any segment of the society can use in any condition. So I think this is something important to say very clearly. One thing is to provide a new option that some parts of the society may want to use. Another thing would be to basically cut out the possibility that some of the current options can be used. So cash is there to stay because it has some features that are very specific to it, very inclusive in terms of users, and therefore needs to be protected somehow. At the same time, also, a central bank digital currency would, of course, need to be designed in a way that is as inclusive as possible, but there will probably always be a thin gap between the usability of a digital means of payment and instead good old cash, so to say.
We have one more question. I think we have four more minutes, and I'll ask this question because I think it's a very interesting one, especially for. I'd be interested in. It's coming from Soren. I'd be interested in the underlying technology. What's your opinion on DLT blockchain solutions? Are these a necessity or just a nice pricey gadget? Well put.
Okay, I'll jump in there. I mean, at the IMF and at least the people I'm working amongst, we always start with thinking about CBDC from a technology agnostic viewpoint. So a CBDC can be based on a centralized ledger or a decentralized ledger, or even could be, and people know me, I hate this account versus token basis thing, but you could have something that's truly token based, and I'm just going to hold this up here. This is an example of true token basis. It's a credit card sized gadget, little keypad, a little it's got a paper white screen, and with this you can load it up at some kind of kiosk, and after that it operates just like cash. It's token based. You don't have to sync up with the mothership ever. You can basically transfer money with this card peer to peer to anyone without and total privacy. Bare digital money. So I think it's important to keep in mind that there's a lot of different options out there. But when a central bank thinks about CBDC, it needs to start at the top. Why am I doing this? And then design around that, leaving the technology choice till the end. That's not what I often see amongst the countries that we talk to, that some vendor comes to the door and says, I got this great new shiny toy for you, and we can build it out for you really fast. And that's all wrong. And one of the chief aims of our technical assistance will be to pull those guys back and say, wait a minute, what are you trying to achieve here? Let's go through this thing step by step. What are your motivations? What are the risks? And now what are the design features you're looking for? Then let's find the technology that fits that.
Thank you. And on that note, I want to wrap it up. John, Ahmed, Andrea, and Henry, thank you very much for your time today. I really enjoyed this panel, and look forward to more of the questions that are popping up now. People are starting to write more of these things, so just keep an eye on those things as the rest of the sessions progress. Thank you once again. Xenophon, the floor is yours.
Thank you very much, John, and thank you very much for our panelists. I see there's a lot of questions, and we can keep answering them over the chat as well as internally. If I can get responses, I will send feedback back personally. Without further ado, I want to introduce Jonas Gross, who is project manager at the Frankfurt School Blockchain Center and a PhD candidate at the University of Beirut. I think I pronounced that correctly. His focus is on CBDCs, and he is here to lead the panel for stablecoins. Jonas, the floor is yours.
Perfect. Thank you very much, Xenophon, for the introduction here. I'm really delighted to moderate the panel on stablecoin, where we have really great experts directly from the field of stablecoin. So I would say directly from the industry, basically. So I highly welcome Julian Legoc, Director of Policy at the Libra Association, then Stephen Becker, who's President and COO at MakerDAO, Raphael Kosman, who's co-founder and CEO at Trust Token, and last but not least, Manny Rincon Cruz, who's a financial historian and advisor to Ampleforth and Blink. So here we basically have like the most prominent stablecoins and also maybe stablecoins to be here in the panel today. So I'm really looking forward to the discussion. First, before we really go into the discussion, I would really like to define what we are talking about today, because we have also seen in the first panel that there is quite some confusion about basically what a stablecoin is, right? And it's really it should be made very clear what's the difference between a CBDC and a stablecoin. And therefore, when I refer to a stablecoin, and this is also the definition I would suggest for the panel, is a quite general one, but it's from the ECB, from the 2020 paper, stating that stablecoins can be generally defined as digital units of value that are not a form of any specific currency or basket thereof, and that rely on a set of stabilization tools to minimize fluctuations of their price against such currency or currencies. So this is basically a quite general definition, but I think this really covers also all the tokens we will discuss about in the panel. And it also quite specifically differentiates stablecoins from CBDCs. Perfect. So to give you a small outline before we really now start with the content, in the next about 40 minutes, we will talk about stablecoins in general, about discussing the different projects which are out there and where the panelists work on. Then we discuss use cases. And as we also had a great panel on CBDCs, we also ask the question, well, how do stablecoins and CBDC fit together? Or maybe they don't. And these are questions I would really like to discuss with the panelists. And yeah. Great. So maybe let's start also with a very brief introduction round. So maybe everybody of you panelists could just very briefly introduce yourself again, if you have something to add to my very brief introduction, and could just very briefly explain how your work is related to stablecoins. And maybe I would start with Stephen. You already unmuted yourself, and then we go to Julian, Raphael, and last but not least, Manny.
Okay, super. Thank you very much for having me today. My name is Stephen Becker. I'm the Chief Operating Officer of the Maker Foundation, which is the organization that produced and deployed the software for the protocol that underlies MakerDAO. And the emphasis here is MakerDAO is separate and is a decentralized entity from the Maker Foundation. And it really is the foundation's job to bootstrap the further development of the software together with this decentralized community. And what MakerDAO is really well known for is generating a decentralized stablecoin called DAI, D-A-I. There we go. Thank you.
Perfect. Thanks. Then let's continue with Julian.
Well, good evening to many of you, and it's a pleasure to be here. Hope everybody is staying safe and well. I'm part of the Libra Association. I'm the Director of Policy. Have been with them for the past about 14 months now. And my background is I am a former bank regulator in the United States, about 10 years with the Federal Deposit Insurance Corporation. And since Libra has been mentioned, I think we were called elephant in the room earlier by John. I won't go into what we're trying to do, but as you're well aware, we had a second white paper that came out in April of this year. And we are essentially trying to build a digital infrastructure for payments for the 21st century. So with that, on to the next guest.
Thank you. Raphael, want to continue?
Sure. Hi, I'm Raphael. I'm one of the co-founders and the CEO of Trust Token. And Trust Token is the maker of True USD, which is one of the largest US dollar-backed stablecoins in the world today, with hundreds of millions of dollars in circulation globally. And since launching True USD, our team has actually launched a couple of other stablecoins as well. We've got Canadian dollar, Australian dollar, Hong Kong dollar, and British pound. So we've become one of the largest providers of stablecoins today. And I think we've got a great panel. It's good to have so many different perspectives here from different styles of stablecoins. Excited to see what happens.
Thanks, Raphael. Manny, would you also mind introducing yourself?
No problem. My name's Manny Rincon-Cruz, and I was a co-author of the Ampleforth white paper a couple years ago, I think, now. And I'm also an advisor to Ampleforth. And Ampleforth is known for producing, I guess, the first rebasing token, which experienced kind of a boom during this DeFi summer. And then, now there's hundreds of clones out there. And then the bulk of my work is primarily in financial history. It's kind of what I research and what I write about. And, I'm primarily focused on understanding how changes in society and technology move financial innovation forward.
Perfect. Thank you very much for the introduction. So now to get also the audience a little bit more into what you guys are doing, because we have you are all obviously working on stablecoins, but the stablecoins are very different. I hope you all agreed on that. So maybe we take another round, everybody of you very briefly just describing. I just mentioned the definition: a stablecoin has some mechanism to stabilize the price, so that you can maybe just very briefly specify what this mechanism is. So is it maybe collateral? Is it some algorithm you apply? That's the first point. The second is which technology do you use? I think that's interesting. And the third one is, are you live yet? So this would be like the three interesting components to classify your stablecoin project. And I would stick to the order we just had. So I would ask you, Stephen, to start.
Okay, certainly. Thank you very much. The one thing I probably need to start with is calling out the fact that we've got a panel here, and we've just had a discussion about CBDCs that was really insightful, and I really enjoyed that. But the premise of this is the implication online that it all comes from a centralized point. There's a centralized context where there is a controlling function given to a central body. So in order to get a sense of what MakerDAO does, let's talk about MakerDAO generally first. MakerDAO is essentially an entity that is made up of a protocol and a decentralized community. And the last three letters of the name MakerDAO really sort of emphasizes that. I mean, it stands for decentralized autonomous organization. There is no central party controlling this organization. The foundation that I work for is just yet another member in the community. MakerDAO was conceptualized really pre-Ethereum in around 2014, 2015. It went live in 2017 and is consequently one of the most established entities in the decentralized finance space, or rather known as the DeFi space. Now, the objective of MakerDAO is to provide a platform for really the development of a blockchain economy. And one of the primary tools it uses is the ability to generate credit in the form of a decentralized stablecoin, which is, again, just for emphasis, is a stablecoin that is not issued by a central party. So to use the Financial Stability Board's vernacular, I would say that MakerDAO's stablecoin DAI is a crypto asset-linked decentralized stablecoin that currently references the US dollar. And at present, there's approximately $1 billion worth of DAI in issuance right now. So I think that sort of wraps it nicely up.
Perfect, thanks. Julian, what about Libra, the elephant in the room?
Thank you, Jonas. Well, I'm going to try to hit as being your German. I know you want 1, 2, 3, so I'm going to stick to the script of 1, 2, 3. So number one, each stablecoin on the Libra network will be backed, fully backed by a reserve. And that reserve will consist of high quality liquid assets comprising mostly of cash and cash equivalents and very short-term type government securities. What does that mean for Libra coin holders? Well, that means that they should have a high degree of assurance that when they've converted fiat into Libra coins, that they'll be able to convert Libra coins back into fiat. And the last thing on the reserve is the particular reserve will remain protected by a capital buffer. So in stress type scenarios or financial crises like the Great Recession we saw in 2007, 2008, that will provide protection against any type of losses arising from operational risk or credit risk or market risk. The number two, now on the technology side of things, our technology is open source, residing on a blockchain backbone. In fact, for any engineers out there that want to go take a look at the code, it's on GitHub. I welcome you to look at it. It's way beyond my pay grade. So if you have any questions, I'll make sure I route it to the right technical individuals. And the last thing about where we stand on launch and live or not live, we are not live today. As you're well aware, we have been seeking permission rather than forgiveness and working with global stakeholders around the world. And essentially, we have 3 trains that need to arrive at the station.
Je suis très mécontent de tous les deux.
Ah, il y a quelqu'un en français qui n'est pas muté. Okay, I will continue. So I was telling one of our panel members backstage, there are essentially 3 trains that need to arrive at the station for us to be able to launch the technical side of things, which is progressing wonderfully. The operational and organizational readiness, we've made some key hires this year in the association. And third is regulatory approval. And until we have a regulatory approval or a puff of white smoke like you would see in the Vatican from our Swiss FINMA, then we will not be able to launch. So I think that's 1, 2, 3 for you, Jonas.
Perfect answer. Thank you, Julian. Then Raphael, what about True USD or also your other tokens?
Yeah, Julian, one question on that before we move on. Are you still envisioning Libra being backed by a single currency or a mix of different fiat currencies?
It's a good question. So definitely, we think we will have more than one single currency stablecoin. And the Libra coin is also, I should stress, it's still in play. But essentially, the Libra coin is really used for remittances and cross-border payments, where you essentially have a stapling of single currency stablecoin, which would make the Libra coin. But essentially, we know that US dollar stable coins have large market caps, good liquidity. So that's most likely a good start for us, but it doesn't preclude us from then, of course, having, a Libra pound, a Libra euro, hopefully, and other type of single currency stable coins. Thanks for the question, Rafael.
Cool, that makes a lot of sense. That's how we envision the future going as well. So Jonas, to answer your question, our project TrueUSD is live. It's one of the large stable coins that's in the market today, and it's traded on all kinds of big exchanges like Binance and Huobi and so on. And it's got several $100 million of market capitalization, used in about 115 different countries. And the way it works is very straightforward. So people would generally consider it not as decentralized as DAI, which Stephen was just describing. TrueUSD is just backed by US dollars that are sitting with our banking partners, and anyone can go to our website, trusttoken.com, create an account, and then send in a wire. Like if you send in a $10,000 wire, we'll give you 10,000 TrueUSD. You give us 10,000 TrueUSD, we'll send you a $10,000 wire. So it's just one-for-one backed, very simple. And in terms of how it stays stable, we actually don't have to do a whole lot of work there because everyone knows that it's backed one-for-one with US dollars. And so if it's ever trading at like $1.01 on an exchange, then some market maker or trader is going to go and mint a bunch more TrueUSD, sell into the market, and they capture that 1% ARB, and they help bring the price back into line, back to $1. And if it's ever trading at 99 cents, then they do the opposite. They buy it off the market, redeem it, and they capture a 1% ARB. So
and
that
it's
happens pretty quickly.
100% backed, right? Just to get this.
100% back, dollar for dollar. And we actually do 24/7 real-time attestations. We're the only stablecoin to ever have done that. So we work with an auditing firm that connects directly to our banking partners and attests to those funds being there real time. And they actually just launched something where they put that information on chain via a Chainlink oracle, so that smart contracts can actually reference that and know that the True USD is fully backed. And they're seeing that from a third party.
Thank you. Last but not least, Manny, I would say Ampleforth is a little bit different, right?
Yeah, so I feel like as an academic, I always do this. We're just like, well, let me push back against the framing of the question itself. Ampleforth is not, I would say, it's not really a stable coin. It's a rebasing token. And the way that I would sort of elaborate on the definition is that stable coins really have low volatility, right? The price of True USD today will be almost the same, tomorrow and a week from now. Same with DAI. What a rebase mechanism does, or what a rebase mechanism does very well, is it mitigates the risk of large and permanent deviations in value. So for contracts that are denominated in Ample, the price of Ample will be quite volatile by double-digit percentage points. But the market cap of Ampleforth has increased by 1 or 2 orders of magnitude since launch. And yet, if you had taken out a debt contract denominated in Amples, the value of that contract would not have increased 1 or 2 orders of magnitude. So just for those of you who are not familiar, the way that Ampleforth works is it's not collateralized. There's a decentralized protocol that was launched almost 2 years ago. And the way that it works is that you have a certain ownership of Amples, and there's a target price. So it's indexed through a system of oracles to the US dollar of 2019. So it's inflation proof in one way. And depending on how much the deviation is between the price of Ampleforth average over the last 24 hours to the US dollar, the balance of Amples will increase or decrease, right, proportionally in all the wallets throughout the world. And so what's happening is there's sort of this equitable kind of distribution or burning of you could call it, of tokens, this increase, or we call it expansion or contraction of tokens. And so then this will then be transmitted into trading activity, which will then push the price either down or up relative to the US dollar. In terms of the technological basis, Ampleforth is chain agnostic. Currently, it runs as an ERC20 token on top of Ethereum, but there's a number of initiatives, and the protocol is ready to be kind of extended onto other chains. I'm not going to preempt the rest of the team on making those announcements because they're going to be forthcoming, but just keep your eyes on the space. And in terms of time horizon, it's been live. I think we celebrated 500 days of rebases a couple of days ago. So it's been almost 2 years now, I think, since being live.
Perfect. Thank you very much. So to briefly summarize how your stablecoins, I will now also call Ampleforth stablecoin for the rest. I hope this is fine for you. to classify how it is backed, please correct me if I'm wrong. I would say that then DAI is backed by crypto assets, and it's like it has a soft peg to the US dollar. Then Libra is obviously backed by bank deposits or by fiat currencies and government bonds. Then True USD obviously 100% with US dollars, and the other True tokens with 100% of the other currency also obviously here. And then Ampleforth like with not really backed, but with an algorithm which like kind of determines then the price. I hope I got this right. Yeah.
Sorry, Jonas, just to extend upon your description and categorization, the one thing I think is extremely important, because again, it becomes implicit when you refer to it's backed by, you constantly think that there's a central repository where the reserve is kept, and consequently the stable coins or the tokens are issued on the back of that. As far as MakerDAO is concerned, there isn't a central repository. Basically, and just to highlight this, and I'll do it very quickly, the concept is kind of simple. Really, if you imagine having yourself, let's say, $1,500 worth of gold, and you took your gold and you put it into this very smart vault that you had in your cupboard. And as you put that gold in your cupboard, it basically generated a little sign for you and saying, well, you can now take out $1,000 if you wish. And you say, well, I want to go buy myself a new pair of sneakers. You take out, $100 and you go buy yourself some sneakers. And in turn, what you do is you come back after a while and you put the $100 back into your own smart vault in your own cupboard, and you can take out your gold. The point I'm trying to make here is it's decentralized in the extent that the collateral that you use, the crypto asset collateral that you use, belongs to you. The vault that you place this in belongs to you. And the credit that you generate from it belongs to you. There is nothing in that supply chain that is at all centralized. So that's the only emphasis I'd like to bring to your descriptions. And thank you for that.
Thank you very much, Stephen. This is really a very interesting point, and also, yeah, really good to notice this difference. So thanks for bringing this up. After we've now kind of talked a little bit more from the definitory side, like how your project is backed, let's maybe get a little bit more practical, because I think this is also interesting for the audience here. What do you think, basically an easy question, what are the main use cases for stablecoins? Why should people maybe use stablecoins or your respective stablecoin? I would here start with Julian.
Thank you, Jonas. Well, I really think that we're entering really a realm of optionality, and I really think it's evolution. And I think for Manuel, that's a history buff, you might like this. In the United States, at the end of the 1800s, they started printing $10,000 notes. And in the 1945, they stopped printing those notes, and they were in circulation until 1960s. And then in the 60s, the United States Federal Reserve decided to stop those notes in circulation because they felt like checks and credit cards were going to take over cash. And here we are 50, 60 years later, and 70% of the world transactions are still occurring in cash. Now, the difficulty with cash is that when you try to send an individual money across the Atlantic, for example, on average, it costs 6.8%, according to the World Bank's latest data last month. Therefore, the biggest use cases we see for a digital payment system like ours starts with remittance and remittance costs, and trying to bring down those costs according to the United Nations Sustainable Development Goals number 10 from 7%, stubbornly high 7% over the past decade. It's varied between 10 and 7%, down to approximately 3%. And we think that large scale innovation is the only way for us to get down to that 3% average. So remittances would probably be the primary use case, Jonas.
Thank you. What about the others? Do you have some use cases to add?
Yeah, well, I would add, I think it's important to really question, like, what is the advantage of a decentralized currency over something like, let's say, PayPal or Venmo? You can send money to lots of places in the world using PayPal, but it's not decentralized. And I think that one of the key things that a decentralized currency like Libra or TrueUSD or DAI or Ample provides is the ability for any developer to be able to integrate their app with that currency. Something like PayPal, your PayPal money is basically only useful within the PayPal ecosystem, within that app. Whereas a currency that's decentralized, it can be listed on hundreds of exchanges, it can be integrated in tons of apps, and that allows it to achieve especially a kind of cross-border pervasiveness that Manny was just, or Stephen was just mentioning. Being able to have many apps in many different languages, targeting many different markets that can all use a single currency.
Perfect. Stephen, want to go next? You also unmuted your phone. And Manny, then you afterwards.
I think the one thing to really emphasize here is when you have I'll get into the use cases, but the use cases are becoming so prevalent that you need to really take a step back and realize that you actually need a lot of stable coins. I'm not talking about one project having a lot of stable coins out there. What I'm saying is you need a lot of projects. You need a lot of stable coins coming into the market, because these use cases are going to emphasize the granularity of consumer needs and consumer wants. And you're going to find that certain stablecoins are going to serve that purpose very well, where others may not. And that situation may change depending on, the consumer, where they are, the jurisdiction, and their need. So the one thing I really like about this panel, it stretches from, centralized reserve-based all the way through to, decentralized credit generation. It really looks across the entire spectrum. And I think that is a very important point to keep in mind, especially when we go into the regulatory components of the conversation. But as far as the use case is concerned, I always get a little bit taken back by the question, because I think I've been in the space so long. I always have this counter question in my head, like, well, what can't you use it for? What use case can't you use it for? And, folks come to me and they give me some really valid examples. Like they say, well, I can't go down to my grocery store and buy groceries. I can't pay for my child's school fees. And then I think about it for a second. I say, well, actually, that's just because of one of two things. Either it hasn't been integrated yet to Raphael's point, or it hasn't really been, rather the instrument hasn't been presented to you. So, as an example, right now you can quite easily use a debit card that's been issued by like Wirex or Coinbase and go to Starbucks and buy yourself a cup of coffee or die. The same, on the same note, you can actually find there's a lot of integrations that work with banking apps that allow you to go pay your school fees with DAI or USDC or AMP or whatever the case may be. Now, the point here is that the use cases are becoming really prolific in the sense that the traditional economy and this on-chain economy is starting to see how they can connect. And so consequently, when you think about it from a broader term point of view, going to the Starbucks to buy yourself a cup of coffee, all the way through to remittance payments and your traditional cross-border payments, all of this is already in place and solved, but very much dependent on the protocol. So the use cases start from what can the protocol do in terms of being a rail, and then what does the stablecoin on top of it do to differentiate the capability of that rail.
Thank you. Manny, do you have something to add?
Yeah, I have actually 2 points to make. I think in terms of thinking about use cases, there's the historical framing that whenever economies have tended to expand and there's an increased demand for money, especially for like small denomination, that tends to trigger the private issuance of money. I mean, we see this cycle happen all the time in China, where a lot of minting was done by sort of local organizations. And the last time that we had a technological innovation coupled with that was during the Industrial Revolution. So especially in the British Isles, there was a demand for small denomination tokens. And the way that people used to produce coins was to use the precious metal as the anti-counterfeiting kind of mechanism. And producing a token where the value of the metal was not the value of the token itself was very hard. So, private mining companies started minting these copper tokens using very advanced machinery. And so that used to circulate quite, for a while, until the Royal Mint, of course. There was a 40-year period where private minters were doing this, and the Royal Mint at some point says, hey, we can do this too. And so, the demand for money triggers, is usually coupled with a technological innovation for private issuance. I think the use case that we really have to think about is, providing a type of utility that's different from what a CBDC will eventually do, right? Because historically, most users tend to default to the state-backed rather than the private-backed money. The second point that I wanted to make, and perhaps this is the other elephant in the room, is really the Chinese CBDC project. And I think, I'm writing a paper, so I don't have the conclusions fully formed yet, but the institutional history of the PBOC is one that's very different from other world central banks. They're guided by a ideology that dates back to the 1950s, which is about seeing and managing the economy, which is using sort of monetary systems and accounting to really implement the planned economy. So I would say another use case, which, is not, does not apply to anyone here on this panel, is really surveillance and I guess economic management.
Mm-hmm. Yeah. Manny, one follow-on question there. what do you see as the role for stablecoins in a world with lots of CBDCs?
Right. I think the composability aspect is key. I think the ease of integration is another feature, and I think the censorship resistance is I think truly valuable in many ways. I think for Ampleforth specifically, the fact that we're kind of inflation proof because we're pegged to the 2019 USD dollar, unless the community votes and they can change that peg however they want. I think that's something that's quite valuable. But I agree with the rest of what Julian and Steven said. There's a lot of use cases for integration in fintech and cross-border remittances as well.
Yeah, it's really a good question, Rafael. This was also on my list, so maybe let's elaborate on this one. So, what are, from your perspective, also? I mean, you often hear that if CBDCs are live, then some stablecoins at least could be dead, right? Maybe not dead, but could be remarkably threatened. But maybe here, what are benefits stablecoins have? And Steven, you're shaking your head, so you first go to you. So what do you think? Which are advantages of stablecoins? You also mentioned inflation, being inflation-proof, and many. I see this point, but are there other advantages of stablecoin? And let's start with Steven, and then go to Julian and Rafael.
I think in the previous panel, I may get the name wrong. I think the gentleman's name is John Kiff. Is that correct?
From the IMF, yes.
He mentioned something very important right at the end of the the panel, where he said, well, when you look at CBDCs, it's up to I think it's IMF is worth. They've got to look at it from a top-down view, like what's the purpose of it, and then trickle it all the way down to the underlying technology. When you have a look at a technology like MakerDAO, what it's done is it's taken the technology first and saying, well, let's have a look at blockchain. Let's have a look at Bitcoin as a blockchain and see what it's trying to achieve. How do we layer a protocol on it in order to create a new feature that allows it to become more stable? And Ethereum and MakerDAO is a great example, because MakerDAO lives on the Ethereum public blockchain. Now, why do I bring this up? Because if you think of that spectrum from the IMF top-down concept of why do we want this, and from a bottom-up point of view of, well, what's the technology that can actually go ahead and do it, you've got this spectrum of capability in between. So you may have a situation where a jurisdiction centralizes the control of a CBDC and tries to create an enforcement device through it, where you may find other jurisdictions that have, let's call it a more sort of open economy, looking at the private sector to develop this in a way that is more competitive, more granular, and more substantive. So you're going to have this sort of way off between a government-created product versus private enterprise, and that is an age-old problem. And we've seen already from it where that tends to lead. So it's a case of saying nationalize it first, privatize. And that argument just comes straight into the question of designing CBDCs and how stablecoins can actually interact in a way to create the necessary competition. If you have a CBDC that is particularly onerous, you'll find that folks will go into the more private issued stablecoins. And if you find that the private issued stablecoins in a time of extreme angst doesn't provide the necessary safety, you might find that a retail CBDC may be account-based. And instead of folks flying into gold for safety, they may fly into these CBDC accounts for safety. So there is a massive a spectrum of capability that we got to keep in mind. So I don't think that there's a question in terms of what's the arms race between CBDCs and stablecoins. And not to get all zen here and quote the movie, quote a phrase from the movie The Matrix. There is no race. It just actually is a realization of something that we've never seen before, and that's what's so exciting.
Thanks, Stephen, for pointing that out. Julian, what's your point on this?
Well, it's always so tough going after Stephen. I think he said it really well. We have always seen a future where being interoperable and having an open source code, that there would be some interoperability, and therefore we would seamlessly integrate with CBDCs. The previous panel went into great depth and length about general purpose CBDCs versus wholesale CBDCs. You know, my personal view of the future is if CBDCs get into the retail market, they'll probably put downward pressures on regional banking, which are typically the backbone in the US, for example, of small, medium enterprises, as well as in other places in the world. But, you know, we're still several years away from really seeing CBDCs out in the open. Clearly, 70% of central banks are looking into it. Interestingly, though, I think is the discussion that Stephen was starting to bring up around, you know, the type of private money, which is really when we go to a bank and there are bank deposits. I mean, you know, us consumers really don't deal with central banks. Central banks deal with other large corporate entities. They also work with the banks, but they've typically in the past, and I would love to get Manuel's historical perspective on this, but central banks typically have only dealt at the institutional counterparty level. Personally, I think getting into retail CBDCs might be a little too aggressive. But again, you know, I think we're at least 3 to 5 years away from really seeing mainstream CBDCs. And for us, again, the Libra project, it'd be fantastic if we had CBDCs today. We wouldn't have to deal with the reserve and the capital buffer and the auditing, like Rafael has to do 24/7 auditing of his bank account versus the coins that are out there. So it definitely would make life easier right now, but we're just not there.
Thank you, Julian.
So,
yeah.
If I could make a quick point, I think Julian is correct. For a long time, central banks have only dealt with sort of institutional counterparties, but that wasn't always the case. When the Bank of England started, an individual could actually have an account there. It was just, you know, very hard to keep track of accounts on paper ledgers. I think the technological innovation now allows the central bank to disintermediate the commercial banking sector. So the role of a central bank was to kind of coordinate commercial banks in the credit production of money, right? That's kind of the technological basis. Credit as the technology that produces money. We're now at an inflection point where that does not necessarily have to be the case, but as we've seen, at least in China, they definitely don't want to go through that route right now. So I think it's quite unlikely that any developed economy would opt to massively kind of disrupt their existing financial system in the next 5 to 10 years.
Thanks, Maddie. And Raphael, do you want to elaborate as a last on the benefits of stablecoins?
Yeah, I'd agree with Manny that the CBDCs are a fundamental change because they allow for central banks to directly have consumers holding central bank money, which is something that's never really been possible before because it wasn't scalable enough. So it always has been, and except for certain exceptions, commercial banks hold money at the central bank, and then individuals and businesses hold money at commercial banks. And products like ours, TrueUSD, that's really tokenized commercial bank money. And CBDCs are tokenized central bank money, which, if I was a consumer, I'd probably want the central bank money because that's going to be, even if all the banks fail, that central bank money is still going to be valid. So I think it's really the commercial banks that are at significant risk here, and likely central banks won't want to damage the commercial banking sector. But also, if they're not going to have their token CBDC held directly by individuals and businesses, then is it really useful? If it really is just settlement between banks or other large players, I'm not sure that it provides almost any value over just having an electronic account in a centralized fashion.
If I can add to that, Rafael, I think you're so right on the pressure on regional and commercial banks, and I think it's one of those moments in time where a lot of the smaller banks don't have adequate capital to invest in digital transformation, correct? And in a world where 1.7 billion people, you've seen the numbers, don't have a bank account, even in the United States, about 20% are either unbanked or underbanked. Here's a great opportunity for mom and pop banks in the world to partner up with digital wallet providers that have the technology, but not the consumer base, to try to narrow the gap of unbanked, underbanked. So just wanted to add that, Rafael, to what you were saying. I think you're spot on.
Perfect. Thanks. So maybe let's go to another topic because our time is almost up, and I want to have enough time for questions. So just a topic. I think we could discuss this also for hours, but I nevertheless want to ask you guys. Maybe you can answer briefly, and this is to Stephen and to Raphael. Now there has been a MiCA regulation proposed, right? So a regulatory framework for stable coins and crypto assets on a European level. I would ask you first, Stephen, and then Raphael, how does this affect now your project? Do you have to adapt, and how?
Well, I'm going to answer this in a bit of a left field fashion, if you don't mind. So the first thing we need to recognize is that pre-Libra, stable coins were mostly a fascination. And a lot was really thought about it, but as far as the size, implication, and the sort of forward momentum was concerned, I don't think it was taken terribly seriously. Enter Libra. And if you think of the hurdles that really focus, that really are in front of stablecoin adoption, it really is about regulation, distribution, and infrastructure. And all of a sudden, you got someone that comes along who's got that distribution. Now it's really serious. And so consequently, you've got a natural reaction to it. And that reaction is, well, let's create something that is substantive and considered in terms of creating some policy and creating legislation that can, not hinder this innovation, but obviously bring it all to bear and make it as constructive and value creative as possible for society at large, because that's what policymakers are looking to do. And when you read MiCA, and I must admit, I couldn't go through all some 200 plus pages of it, but I did go through some of the important parts of it. It lends itself towards being a very substantive and considered approach to stable coins. But again, I always think to myself, what does it do to cater for the full spectrum of stable coins? And a thought experiment I always want to put forward is, well, imagine if Bitcoin had a stable value. What would your approach be? And then to respond to that, I would also go so far as to say, well, when you look at decentralization, the characteristics of it is immutability and transparency. And the application of current regulation can still be applied, even in a world if Bitcoin just simply had a constant value and was a stable coin itself. So I look at MiCA and I say to myself that this is a really well thought out, very broad, a broad policy that tries to capture as much as possible. But there is an essence of decentralization, which is really where blockchain started and came from, that it still needs to capture. So consequently, from MakerDAO's point of view, and keep in mind, what happens to MakerDAO is up to the community, the decentralized community, which I generally just call governance. And they've got to look at and decide, well, what does this mean? And the implications of it, as far as I'm concerned, are still to be borne out. I'm not terribly sure as to how it will affect DAI specifically, but I can see the impact that it has on the broader stablecoin industry. And very much like the engagements I have in the US with respect to a lot of the regulators, the trade associations, and policymakers, it's really about getting that intersection where you've got policymakers and regulators realizing that for the first time ever, and be very clear on this, for the first time ever, regulators and policyholders are proactive stakeholders in this whole thing. This is a time where a transaction can be created where you can actually infuse programmability, where regulators can prevent bad acting before it actually even starts. And that is something that is really an inflection point, not only in looking after the good actors and filtering out the bad actors, but really for growth in terms of what an economy needs in order to make sure that it can go in the right direction.
Perfect. Thanks, Stephen. Maybe Raphael, very quickly to add your stance on MiCA before we go to the questions of the audience.
Yeah, so our regulatory team has looked at MiCA and we think it's too broad. I think it would be very helpful if the team behind MiCA can help clarify, why should things like crypto kitties or crypto art be treated the same way as a crypto bond or a crypto dollar? It overall seems to be lumping all kinds of crypto assets together and applying the existing financial services regulation to them, which I can understand why someone may do that to be conservative, but I think that it may be a mistake.
Good. So thanks, Rafa, for your quick answer here. Now we have 10 minutes left. So I would now go to the questions raised by the audience. And I'm really sorry we cannot answer all of them because it's quite a lot. So I hope this is fine with you, and you can also reach out to me, and I think also to the panelists if you're really interested in your answers. So the first one is, I think, quite interesting by Søren, and he asks, there are lots of stablecoins in the market. In what direction do you think that the stablecoin market will develop? So is it gonna monopolize towards the elephant in the room, or are there gonna be multiple providers in the future? And whoever wants to answer this can answer that.
I think this just sort of extends on a previous point I made. I think you're going to have multiple providers. It's going to be a case of, the way I imagine it is the topology, the space still needs to be discovered. And the more stable coins come into the space, the more of this landscape is going to be discovered, until you get to a point where you realize that enough discovery and development has taken place where now you turn into real competition. And so I would say that that kind of wave is something that you need to look forward to.
Rafa, want to add something?
No, I think that's a pretty fair answer.
Okay, perfect. Let's come to the next one. This is to Julian, and I think also quite relevant. What about potential negative interest rates? So I assume it's also meant if the negative interest rates on the bank account potentially, but also on your government bonds, which are in your Libra reserve.
Yeah, absolutely. And I think majority of the developed world right now is at 0 or negative interest rates. I think the US is just a little higher, around 0.8 or 0.9. So definitely the business model needs to remain conservative based on sustainability for the project. And so in a world where all interest rates are negative, including cash deposits, then it would have to have the introduction of transaction fees into the system, something that we've always said would remain at near zero as possible. Peer-to-peer, of course, being as near zero possible, but merchants may want to introduce some fees. And certainly, thankfully, having 27 members that have catalyzed the startup costs of the network and have helped bring the nodes up and the blockchain up, we feel like we have some support from our members.
Mm-hmm. Thank you. Julian, we have actually another one for you.
Jonas, if I could add to that.
Yes, of course.
I want to mention that the business model for Trust Token with our stable coins and for many other issuers is based on that positive interest rate. Like, right now we just make the spread between True USD holders don't make any interest right now in their True USD unless they, invested in something. But our company makes as our revenue the interest on those US dollars, which is a fairly low interest rate today, given just the economic climate. And it is part of the reason why we haven't yet launched a digital euro, is actually because of the negative interest rates. And it's not at all easy to see how you make a business model in that situation.
Thanks for adding this. Manny, do you also have something to add? You unmuted yourself.
Yeah, I was going to say, I think negative interest rates are important to keep in mind. There's a paper, I think dissertation by Paul Schmelzing that came out, which basically tracks negative interest rates on safe assets as declining over the last 800 years. It's not just a product of current central bank policy. It's kind of a feature almost of capitalism. And I think one of the stablecoin use cases will be facilitating the search for yield, I think, in decentralized finance, right? As people decide to opt for non-CBDC money.
Mm-hmm. Thanks. Then, as promised, Julian, the next question to you, it's again on the reserve. And the question is the interest on the reserve that goes to the, sorry, I lost the question, to the shareholders, not completely the opposite of the democratic philosophy pursued by cryptocurrencies? That's an interesting one.
It is a very interesting question, and I thank you for being open and candid with that one. So if I put my philosophical hat on, I think there has been a push for cryptos being decentralized and being extremely democratic. What we've realized over the past 16, 17 months working with world regulators is that they weren't quite comfortable yet with complete decentralization. and therefore they wanted to ensure that they had a belly button and a postal address of the Libra Association, which is something that we've done. So I would love to actually get, I see a whole bunch of my panel members that are chuckling, Manuel, Manny, and Rafael. So I'm sure you guys can also answer this, because I know where you stand on the whole decentralized, but I think it's a great philosophical question. So I would love to get the other guys on the panel here, their perspective.
Sure.
One thing that I would mention is just that passing on that interest to token holders, while that could be seen as more fair or decentralized, does present a regulatory issue, because it's much more likely to have the token be classified as a security or as some kind of deposit with a bank. Having the token itself not have interest, as most stablecoins today don't come with any interest, that it puts it in a much clearer zone from a regulatory perspective.
I was smiling primarily because I love the phrase about coins having belly buttons. I think I'm gonna use that going forward, if you don't mind. I think there is a case to be made for being, I think, centrally regulated in the way that Libra is aiming to do. I think there is a real need for that. If we think about sort of the geopolitical context of what's happening in the world, right? So I think there's a lot of developed market concern in the US and Europe about, surveillance monetary systems developed by the Chinese. And, at this point, I think, the Fed is quite behind on this. So would you rather have, Libra step in and kind of, sort of sow the field, I think, in a way, or would you rather have sort of Alipay and WePay come in? So I do agree there's a difference in philosophy, but on the other hand, some might say that's quite a pragmatic trade-off.
Great, thanks for your thoughts on this one. Then the next question is again is related to Mika and to e-money. So I think the question is to all of you guys on the panel, and it is: will stablecoin issuers such as Libra try to have their tokens classified as e-money instead of crypto tokens? Whoever wants to answer this, if there is anybody.
It's a difficult one. I think there's a lot of different ways that a stablecoin can potentially be classified, and they've got all kinds of different advantages and disadvantages. So it's hard to say.
I hope our lawyers are not watching this, because I'm not entirely sure, but I think at the moment we're currently classified as a commodity. So I don't think we fall under those regulations.
Okay, so I would say one last question, and this is basically about what are basically the main hurdles today? So why are our stablecoins? I mean, they are obviously increasing in usage, I think, tremendously. But what are the biggest hurdles still to get more ground for being used in use cases? Again, to everybody.
Well, I'd start by saying this whole stablecoin sector has grown massively over the last couple of years. Like, I think when we launched TrueUSD in 2017, the only major stablecoin was Tether, and its market capitalization was maybe like, I don't know, 100 million or something like that. And now Tether's at about 15 billion. The total market cap of all stablecoins is probably 18, 19 billion, something like that. So it has grown tremendously. Of course, you still can't go to the supermarket and check out with your stablecoin, but overall, the market's been growing really, really well, and probably will continue to do so.
I think what Raphael said is quite true. I mean, I think just for DAI, right, I think the outstanding amount has increased by an order of magnitude. I think it's at least 10x just over this year. I know it's the same with Ample. I think what's going to be driving a lot of adoption soon is really financial services that provide what people want. And right now, they wanted yield this year, and given sort of stimulus, in response to the pandemic, it will probably be that as well next year.
Stephen, want to add something?
Well, generally, when it comes to the hurdles, as I mentioned before, it's regulation, distribution, and infrastructure. But to Manny's point, which is spot on, it really is looking at the finance space, and something that is, I suppose, out the ambit of this particular forum is looking at decentralized finance and how that operates from a traditional finance point of view in terms of bridging purpose and value accretion to the general economy. That's quite an in-depth subject, but just to get back to the specific hurdles, when I think about it, is regulation, distribution, infrastructure. Regulation, we've spoken about. Distribution, it comes down to, well, if you want to go and use stablecoin at your local grocery store, then what kind of payment rail is going to be used. Right now, as I said, you can use like Coinbase has got a debit card, Wirex has got a debit card. You can load it up, and you can go ahead and actually use them. There's a lot of action happening in the background, but effectively it still allows you to use them. We need something substantial. And that's where Libra was really important. They came along, they got distribution, and that's why all of the concepts and value of stablecoin has now been put on the table. Interestingly, though, one of the biggest hurdles is infrastructure. So we spoke about interoperability previously, which has a lot of concerns with respect to what fungibility may look like as stablecoins go from one protocol to another. But importantly, it's actually the base infrastructure. We're looking at the actual internet itself. Is that, which is basically a 40, 50-year-old structure, is that really going to be in place to look after this growing economy that is supposedly going to put throughput that is going to be comparable to what we see in the traditional world? Ultimately, that drives the economic development, and the economic development in it of itself is driven by stablecoin. So it all basically comes back and relates.
Perfect. So let's now do one really last question, because our time is already almost up. Here the question is, the elephant is actually not in the room because it's Tether. So Julian, you unmuted yourself. Why? Just kidding. But here's the question: what is the risk it poses to the global financial markets and to monetary stability? So I assume if Tether is, it's obviously tremendously used, but it's even more used. And how can this problem dealt with, again, to everybody, as a last question?
Well, that's a good one. Tether is definitely the elephant here. They're bigger than every stablecoin on this panel combined in terms of our current market capitalizations. But often when we launched TrueUSD years ago, we thought Tether is going to go down in flames. We thought Tether is going to completely blow up, regulators are going to shut them down, and they're going to be entirely replaced by much more trustworthy stablecoins such as DAI or TrueUSD or Ampleforth or Libra, more compliant, more legit products. And that hasn't been what's happened at all. They have done phenomenally well, even with having regulators go off after them. They're just growing and growing. And the major exchanges continue to do tons of volume in Tether. They haven't, to a large extent, delisted Tether or removed support from it. So I suspect it's going to be around with us for a while, and it's probably not going to go down anytime soon. That's my guess.
I would create a bit of context here as well. And this is sort of sidestepping the question a little bit. Tether is at 15 billion, but if you have a look at any sort of money-centered bank, that's probably how much they process in payments and derivatives in an hour. So in the context, the size of the stablecoin industry right now has grown fantastically, but you always have to come back to the traditional world and say, well, what is the size and what is its impact? So when the question is about the risk it poses to global financial markets and to the monetary stability mechanism, it really comes down to transmission, and transmission requires throughput. And right now, there isn't a stablecoin at that level that can actually, compete or thrive at that dimension. And again, I'll bring it back to Libra. That's why it is so impactful, because it does have the distribution and has that capability. And it is the project that basically puts stablecoins, on the table.
So thanks. Thank you very much for your insights here. We are unfortunately 4 minutes over time, so I have to stay German here and really to interrupt. So thank you all for being here for the discussion, to Manny, Raphael, Julian, and also to you, Stephen. It was really my pleasure to moderate this. I would I would have loved to continue this for hours, obviously, but yeah, I'm very happy to hand over to Xenophon again. So thanks for having us.
Thank you, Jonas.
Thanks for having us.
Thank you, everyone. That was a fantastic panel. For the closing remarks today, we are going to move forward and hear Mr. Robert Sams speak. Mr. Sams is the co-founder and CEO of Clearmatics, as well as the co-founder of Universal Settlement Coin, or USC, which is a pretty big project in Europe. Without further ado, Mr. Sams, I give you the floor, and I'm going to help you by sharing the presentation for everybody.
So thank you very much, Xenophon. And thank you everyone for giving me the opportunity to do the closing remarks of this amazing panel. A set of panels. I really enjoyed listening to both of them, and I think this is sort of our experience through the crypto and digital cash journey over the last 6 years. In many ways, it covers kind of the content of both panels. We co-founded this project with UBS in 2015 called Utility Settlement Coin Project, which was is a project to create a digital cash settlement asset, so a tokenized cash settlement asset for wholesale use that's fully collateralized by a central bank reserve, and really interesting properties of the payment rail, given that the cash settlement asset runs on a Turing blockchain, etc. So we had it turned into a large consortium engaged with central banks quite early on, before CBDC became a really hot topic. But before all of that, we're actually really involved in the algorithmic stablecoin space before it was a space. Before it was. It was really considered interesting or useful by very many people, with a few exceptions. I think that like the MakerDAO team is one of them, who were very early and created an amazing project. And I was asked to give a presentation, so explaining the mechanism behind this particular algorithmic stablecoin scheme called Seigniorage shares, which was part of a paper published in 2014. And the Seigniorage shares schemes is very different from MakerDAO's scheme, but it's not a collateralized model. Several projects have attempted to implement it, or a variation of it, and some are today. So I'm going to give an overview of how that mechanism works, and then also share some of my thoughts on where I think algorithmic stablecoins may go in future, and let me get started. So this is the 2014 paper, and at the time, everyone is still thinking of like crypto as, in the community was thinking of crypto as like digital gold. And the motivation for me for doing this research was really nothing to do with central bank digital currency or tokenized e-money. It was really all about how to give a cryptocurrency that is a pure cryptocurrency, has no issuer, is completely decentralized, in a system that has the censorship-resistant, properties of the cypherpunk vision, but is stable. Like, so it's actually like used as a medium of exchange and unit of account. And the idea behind it is quite simple. Like, if you want to do this, you need to create a model where the where the supply of the cryptocurrency dynamically adjusts with the demand. And all cryptocurrencies at the time, were based on deterministic supply schedules. With a deterministic supply schedule, if you have an increase in demand for your cryptocurrency, people get excited about it and start onboarding. Demand goes up, supply doesn't. All of the change in demand is absorbed by price. And so this paper was identified two problems, two hard problems that need to be solved, in order to create a stabilized cryptocurrency. And the first is well, how do you measure the the changes in demand without without introducing new trust assumptions? Because this demand is a market variable. It's facts in the outside world. How does the protocol get to know about those facts without relying on a trusted third party to provide data feeds to an oracle, etc. So that was the first hard problem to solve. And then the second one is how do you distribute the changes in the coin supply? So it's one thing to say when the demand increases, you increase the supply, demand decreases supply, but to whom are the new coins being credited, and from whom are coins being debited when the supply decreases? And the paper was about addressing the second question. And then just sketching some thoughts on the first one, but not attempting to address that. Let's move to the next slide. So I'm going to give in 5 minutes an explanation, a high-level explanation of how the mechanism works. And it's actually quite simple. What's kind of more interesting is kind of understanding why it works or could work. So the key ingredients of the mechanism are, first of all, the four key ingredients. First is there are two coins. There's a stable coin, and let's call that mass. And there's a volatile coin, and let's call that energy. Second component is there's a stabilization target, p hat. And this is the index of purchasing power that you are trying to stabilize the mass, the stable coin against. And the third component is purchasing power oracle. So this is related to that first problem, which is somehow the market facts about the purchasing power of that coin get represented to the protocol. And then the fourth is a voluntary market rule for converting mass into energy and vice versa. So converting one coin into the other. So we go to the next slide. So the idea behind this is that the demand for the stable coin, if it is a stable coin, the demand curve is going to have this kind of shape, because you demand cash balance that's proportional to the purchasing power of the coin. And because the stable demand will have that shape, if that demand increases, sort of by an exogenous shift in that demand curve, people get excited about the coin and its network and join the network, pushes the coin demand to the right. If the coin supply is fixed, then price is going to go up by a proportional amount. And the next slide. So the simple idea is that if you have this rule that can increase the quantity of the coin by the amount of change in its purchasing power, that you can bring the price back down, the coin's price back down or up to the purchasing purchasing power target. And the next slide. So, so the key question here is well, how do you change that coin quantity? You could say, well, we could just increase everybody's balances when the coin supply needs to increase, and decrease everybody's balances when the coin supply is supposed to decrease. But that doesn't actually really solve the problem, because that doesn't encourage stabilized demand. The way the mechanism works in the Seigniorage shares scheme is that when the supply of the stablecoin needs to increase, you mint new mass coin for energy coin, and you burn the energy coin. When the supply of the stablecoin needs to decrease, you mint new energy coin for mass coin, and you burn the mass coin. So you are always minting one of the coins versus burning the other. And crucially, the ratio at which the minting versus burning operation takes place is done at a market rate. And the key conclusion of the idea here is that there's actually a simple dynamic portfolio argument that shows that showing how to value the energy coin, the volatile coin. The simple portfolio argument shows that you can treat the volatile coin as a perpetuity of cash flows that's equal to the changes in demand. So if you look at all those deltas of the change in the stablecoin demand, some positive, some negative, if on average they're positive over time, you can do a net present value analysis of that and value the stablecoin. And that's the name, the meaning behind the name of the Seigniorage shares, because the volatile coin, the energy, it sort of behaves like having equity in the money printing business. Let's go to the next slide. And actually, just kind of go down to the bullet at the end. So that's how the mechanism works. And so sort of fast forward to the state of the world today, because a lot has happened in the stablecoin space, both the algorithmic and the asset-backed stablecoin space, particularly in the last 2 years, but certainly a lot since 2014. And there are a few observations that we've got. And one is that like stablecoin is more than like an economic mechanism for changing coin supplies. There's like when we're talking about algorithmic stablecoins, there's a lot of emphasis on the mechanism of how you change supply in response to demand. But a stablecoin, in terms of its goal, the purpose of sign is also about changing coin demand. Because the goal is to steer like the speculative demand, where enthusiasts who are bullish or bearish, on the future of a stablecoin in its network. You want to steer that demand into the energy coin, the shares, and you want the transactional demand, the demand for using the stablecoin for its transactional utility. You want to steer that into the other coin. And there's no mechanism that can like engineer like stable-ish demand. So it's a behavioral variable. It's part of the system's environment rather than the system itself. And one of the things about the existing stablecoin, ecosystem is that a lot of the demand, probably most of the demand for stablecoin today comes from portfolio flows, from trading in the crypto markets, and that's fine for the current state of the market today. But in terms of like the long-term viability of stable cryptocurrency, you need to start generating like a stable demand for these tokens, and that all comes down to enriching the use cases and the ecosystems of blockchains beyond trading cryptos. So buying the coffee in DAI, need more of those types of use cases, or just use cases in general. They don't have to be the simple payments use case, but you need more of the transactional utility use case. And the final point is like, why is like fiat currency crypto's unit of account? Because today the market in crypto and blockchain is like the dollar is like the unit of account for crypto. And from a from a long-term point of view, there is something unhealthy about that, and quite disturbing about the blockchain community's reliance on fiat currency as its unit of account. Let me go to the next slide. And this gets back to something related to the first problem in the paper, and I kind of alluded to, like, some of these issues back in 2014, which is like, why the assumption that stability, is like, defined as like relative to fiat currency, because stability is a more general concept, and if it isn't defined as fiat, as pegging to fiat, then what is it? The suggestion that I want to make is that crypto needs its own unit of account. It shouldn't have fiat currency as its unit of account. And if you ask what the unit of account of crypto should be, it should be related to the underlying resource, the cost of the underlying resources and infrastructure of blockchains and the peer-to-peer internet and cloud computing, because these systems, what enable these tokens to exist in the first place, are decentralized networks and blockchains, and they don't run for free. They're providers of block proposers and validators and people who stake value and people who mine proof of work puzzles. What gives these systems the characteristics that they have is this ecosystem of parties that play these different roles, and the roles that they play in providing these underlying distributed resources are costly. They're not free, and the remuneration of the parties in providing these resources gets paid in crypto. And you can probably expect that the cost of the underlying decentralized compute resources, the costs are ultimately based on cost of bandwidth, cost of storage, cost of compute, etc. That these costs will decline over time, but they'll probably decline in a fairly predictable way. Maybe not Moore's law kind of predictable, but decline in a predictable way. And to have a stabilized cryptocurrency, an algorithmic stabilized cryptocurrency, or multiple ones that are where the stabilization index is defined against the cost of the distributed compute resources, it gives the blockchain ecosystem the unit of account that it really deserves. It represents the underlying economy, the commodities, raw commodities on which the ecosystem is based. But it also has some interesting characteristics about it as well, which is if you're stabilizing a cryptocurrency against the cost of distributed compute resources, that means that the purchasing power of that thing over time is relatively constant. So even if the cost of those resources decline over time, the purchasing power of the coin in resource numeraire be relatively constant. And if you ask the question of okay, why is that useful? Well, the background assumption that we have when we talk about crypto and CBDCs and fiat currency is all about like a human actor, a person, a natural person or company that is initiating a payment or a value transfer event. But the future state is there's a very, very large role for autonomous agents, machines and machine economy, who are trading with each other and need to fund themselves and fund their operations. And if you think about what the machine economy needs in terms of a currency, is a currency that's stabilized against the cost of the underlying resources. The other interesting characteristic that idea has is that if the costs decline over time, the currency itself will be inflationary against broader index of goods, which is actually a feature rather than a bug if your goal is stability. So we'll go to the next slide and then wrap this up and just kind of go through all the bullets there. so the yeah, some thoughts on future stablecoin designs. First is like don't peg. I think in it's a scheme like MakerDAO, which is impressively resilient. Collateralized schemes seem to have managed that well, but the long run history of pegging anything is not a successful one. Pegs almost always break in the long run. Let the stablecoin be inflationary. It's supposed to be a medium of exchange, not a long-term store of value. It's supposed to be high velocity money. And make the the stabilization oracle a measure of the native blockchain resources. And then the final, I'll reiterate the point again, that crypto needs its own unit of account. So thank you for letting me go through that and indulge on the monetary sci-fi. And thanks for your time. And do you have any questions?
Thank you so much for the presentation, Mr. Sams. I am gonna go and look now in the chat group for presentations. But while I do that, I'd like to ask you a quick question. Since 2014, we've seen that the usability of stablecoins has shifted from a trader's tool to a broader, more stable demand for them. We've also seen the emergence of Chainlink as a provider of an Oracle solution for this dynamic peg that is a big part of this mechanism. Do you believe that future stablecoins, major ones, for example, one that has a demand of a token like Libra, would be able with Chainlink to do something like this, to actually make it work? Because other like new shares failed way faster because of too much volatility in demand for the stablecoin.
Yeah, so I mean, I think yeah, no, I think it certainly is possible. The Oracle problem is hard, but but it's been successfully used in other algo stablecoins. So I certainly think it's possible. In terms of the connection with Libra, I mean, I speak for that project, but I mean they're clearly pursuing a very different design goal of an e-money based or asset based scheme.
Thank you. Any questions? Anybody else? Okay, well, Mr. Sams, thank you again for a fantastic presentation. You are well aware of my adoration for your project. Thank you for joining us, and thank you for everybody else. I'd like to just conclude this by saying thank you to all the panelists and our attendees. Wish you a lovely and happy evening. Stay safe out there. And join us for our next roundtable, which is going to be announced very soon. Bye, everybody.
Thanks very much, Sinafon.
Bye-bye.
See you next time.
Bye.